what people told us was that the high oil price caused inflation, but it wasn't. It was the 10 years of money printing since Nixon closed the gold window that resulted in inflation, and it's going to be the same now. The inflation we've seen since 2008. That's what's causing higher prices and currency debasement. If oil were to go to 100, and we'd see commodities a lot higher. And, yes, they're going to blame Iran and the crisis, but ultimately it's the central banks and government spending, deficit spending, and the debt that creates it.
The latest U.S. retail inflation data pleasantly surprised us for the second consecutive month, showing that the tariffs imposed by the Trump administration haven't had the immediate impact some expected. This underscores an interesting dynamic in the market. Policymakers have emphasized that any changes in strategy will likely depend on clearer tariff policies, and analysts are generally optimistic that the Federal Reserve will maintain steady rates for the foreseeable future. MarioInnecco from Innecco64 offers a thought-provoking perspective, suggesting that inflation is influenced less by short-term geopolitical events and more by over a decade of interventions from central banks, including money printing and government spending. He highlights an important point. If oil prices reach $100, the focus may shift to Iran, but the real issue arises from systemic currency devaluation. Currently, the Fed funds rate holds steady at 4.25% to 4.50%, unchanged since the last cut in December. While markets are hopeful about possible easing later this year, a lot will hinge on the upcoming economic data and global developments. In the precious metals market, gold recently dipped below $3,400 by over 1.45% during the North American session, despite ongoing geopolitical tensions. This pullback followed encouraging reports that Iran might be willing to resume nuclear talks, which lifted market sentiment. However, mixed messages from Iranian officials have created some uncertainty. Innecco notes a shift in sentiment. While some analysts remain cautious, many now agree that holding on to gold could be wise. He confidently asserts that gold's true breakout is still ahead, and those who invest for the long haul will ultimately be rewarded. If there is one thing about which one can have confidence in the impact of Trump's economic policies on markets, it is that they will continue to give a significant boost to the gold price. They will do so by further undermining confidence in America's economic exceptionality. That will all too likely precipitate a dollar crisis. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Why is gold back? Well, let me tell you why I think it's back. And it's because of this article here in the FT that came out late on Friday. So they call it the big read. So it's not like on the back pages. How gold became the world's refuge from uncertainty. So there you go. Even the FT now is having to admit that gold is becoming more and more important. They even touch upon the fact that gold is now the second most important reserve asset after the US dollar. So it's overtaken the euro. It talks about how the trade war has made things even worse for the dollar. People don't want to be, how can I say, exposed to too many dollar reserves. And yeah, so there you go. They've got a chart of gold here. And as you see in 2025, gold leads all major assets. So it's outperforming everything: Bitcoin, emerging markets, Swiss franc, yen, energy, everything. They haven't put silver here. Silver is probably second. And they've got a comment here from John Reed. He used to work for UBS. Oh, the other thing they talk about is central banks are plowing record amounts into gold. And we've been talking about that for years. They started in 2022. They're buying net over 1,000 tons, which is like huge, as you can see here. It's in the post-Bretton Woods or post-World War II era, we haven't seen central banks buy as much gold, and they're continuing to do it. So there you go. That's why I think gold is back. And if you read this whole article, there's still a lot of people that are not too convinced, but at the same time, they're admitting that you need to have some gold. And I think they're going to be proven wrong. Gold is going to come back in a major way. That's the way I see it, and you probably know that's the way I feel, and I've been talking to you about for many years. Well, it's at 3,486, which is about 50 bucks higher, which isn't really, yeah, it's quite a bit, but here we go. There's Pax Gold, straight in at 3,486. So I think this was the close here on Friday, around 34, and now it's gone up a little more. Anyway, well, I'll just show you because I wrote down all those closes on my legal pad. So here it is. These are the gold highest weekly close, not just in I owe you nothing's dollar. And this is what John Exter called the dollar, I owe you nothings, because there's nothing behind any of these fiat currencies except debt. So all these major currencies closed at weekly all-time highs, as you can see. And I've got this up as well, the US national debt, because it's approaching, we're very close to 37 billion. So what else have we got here? Oh, this is a post from Mohammed El Arian. He used to work for PIMCO, one of the biggest, well, it's the biggest bond fund. He doesn't work there anymore, but he says here, and this was, I think, Friday, as I've been highlighting recently, don't look to US Treasuries for safe haven or flight to quality flows. Their yields barely budged after the Israeli attack on Iran. Instead, watch gold and silver. The flows are happening. They're just not headed to treasuries as historical experience would suggest.
MarioInnecco emphasizes the importance of gold's stock-to-flow ratio in understanding its long-term value. With approximately 60 years of above-ground supply relative to annual mining output, gold maintains its monetary appeal mainly because it is not consumed like other commodities. This high ratio means that even a significant discovery would have limited impact on its price, preserving gold's scarcity and stability. On a global scale, China remained the largest gold producer in 2024, accounting for about 10% of total global output. Since the 2008 financial crisis, global gold production has trended upward, though output still varies considerably by project and region. For instance, Artemis Gold Incorporation projects that Canada's Blackwater mine will average 321,000 ounces per year in its early years, rising to 438,000 ounces annually between years 11 and 17. In comparison, G Mining Ventures reported 40,147 ounces produced in the final quarter of 2024. Ghana, another major player, recorded a 6% rise in large-scale mining output back in 2019, underlining the ongoing role of developing economies in global supply. Yet, despite these figures, the stock-to-flow ratio continues to underscore the strength of gold. Unlike industrial metals, most of the gold ever mined remains in some form, whether in central bank vaults, private reserves, or jewelry. This structural feature, paired with rising geopolitical and monetary pressures, further supports the metal's enduring value in the face of both inflation and economic uncertainty. Let's get back to the interview.
There's no history of actually technically of confiscation of gold or silver. The Executive Order 6102 in 1933 by FDR was technically not confiscation, even though I believe, I think de facto it was. You're supposed to hand it in, and they gave you something in exchange, paper money, which isn't good. But I think it's going to be a lot harder to confiscate silver, and I don't think many people have silver. So I don't think it's worth it. I think where they could take the silver from is like the ETFs and maybe even some of the miners. They could nationalize mining companies. That's possible, but not like if you're holding silver as an individual. Lane all obliterator. I think I think it's good to buy both, really, both gold and silver. Start with what you can afford, and yeah. Yes, the government might confiscate our gold or silver in the future, but if you didn't buy gold in the last 5 or 10 years because of that, you're losing out. So, and these stories of gold discoveries, they're all like bogus. There's one about Zaire, or was it Zaire or somewhere in Africa, Congo? This is just, you know, it's It takes a lot of investment in drilling and finding like resources. And after you find the resources, it takes years to develop the mine. Yeah, this is just silly stories. And the other thing about gold is that the stock to flow ratio is so high. A stock to flow ratio means how many years of mining production are above ground. And gold has the highest stock to flow ratio because it's money, it's not consumed. It's about 60 years. So even if they were to find and start mining a huge gold discovery, it might not, it won't really affect the price that much. That's what people forget.
Gold's recent volatility highlights the delicate balance between geopolitical developments, central bank strategy, and broader economic forces. While temporary dips reflect shifts in market sentiment, the underlying case for gold remains anchored in its scarcity, durability, and resistance to monetary manipulation. Unlike assets that rely heavily on industrial use or speculative flows, gold's value endures through structural strength underscored by its vast above-ground stock relative to modest annual production. As the Federal Reserve weighs its next move and inflation narratives evolve, investors may need to reassess gold's role not just as a hedge but as a cornerstone of long-term financial resilience. In a world shaped by economic fragility and shifting power dynamics, could gold reclaim its position as the ultimate standard of monetary trust? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.